Yo, what's good, everybody? Welcome back. Okay, so we're going to be looking at PayPal stock today. We'll be doing looking at a little bit of the financials, doing analysis as we normally would, and running our DCF model on them and seeing what the value on the company is. So let's go ahead, not waste any time, and jump right into it. Okay, so if you join me on the screen, we can just kind of briefly look at some of the financials of PayPal just to, kind of get a little look at them and get an idea of if the company is essentially looking healthy right now. So, and remember, this isn't like a deep dive on all of the financials. I'm not like pulling up 10Ks here or anything from earnings, but I mean, you can look at the revenue over not just the past 5 years, but this goes all the way back to 2015. I'm using macro trends under the financials section. And all you've got is year after year growing revenues. I mean, this is what you want to see. This is what you want to see. And in 2021, you had revenue of 25 billion. And I have to just cut in here real quick and say, I got to be honest. I mean, this is kind of where PayPal ran into trouble. The stock price ran up like into the 300 or something like that. It ran up so high because, I mean, not only was 2021 just a ridiculous bull run that literally made no sense for a lot of stocks fundamentally, but then you had financial stocks were killing it then. And then you had a stock like PayPal have a year where they had essentially, 25.3 billion. The year before it was 21.4 billion. I mean, that's almost like basically 20% growth they had over that year. So I can see with the run up and how financial stocks were doing at that time, although now they're doing terrible. But at the time, they were doing really well and add in one of their biggest growing years they've had. And I mean, I can see why people fell into that trap because PayPal was never worth like 300 a share. Fundamentally, financially, just way overvalued. Now they're at about 80 bucks a share. So when we get to the DCF model, we'll be able to take a look and see what's going on. Like, is it finally a deal? We'll find out. So you've got your cost of goods sold and your gross profit. So yeah, it's just revenue minus cost of goods sold will give you your gross profit. As you'd expect for the kind of sector it's in, whether it be like a savvy financial company or even a tech company, you're going to have relatively good margins or higher gross profit margins. And that's no different here. I mean, if you look across the board, it varies in some years, but essentially you're close to like 50% gross profit margins throughout all of these years. So yeah, I mean, that's really good. You can see that their operating income over the years has pretty much done nothing but just increased year over year. With 2021 being the best year they had for operating income. If you look at net income, it's pretty much increased year over year. 2021 was like a little less than 2020, but I mean, basically you've just had this trend of just going up and up and up with all the financials. Okay, guys, now if we look at the shares outstanding, you'll notice a beautiful thing here. The shares outstanding is higher in 2015 than it is for 2021. So they've bought back shares through the years. Not a huge amount, but still, the point is we don't want to see that shares are getting diluted because that rips you off as a shareholder. So essentially, as an investor, you are getting what's called a revenue per share, which is revenue divided by shares outstanding. So if they dilute you, if they increase the shares outstanding, your revenue per each share you have goes down. Not good. That takes value away from the investors. There's so many people that underestimate just how terrible share dilution is for value for the shareholders. So that's why when buybacks happen, even if it's not that big. Buybacks are a huge deal. Just as much as you getting diluted is a ripoff to the investor, an awful thing to see. That a company buying back shares can give tremendous value as well. And again, we can just do a small recap here. I mean, revenues are increasing, gross profit margins are near 50% for almost every year. I think it's a little under if you do the math here. It's like 47, 48% for 2021. But pretty much near 50% and has been for a while. Growing EPSs, growing net income, not diluting shares. In fact, if anything, through the years, it's either stayed stable or back here they actually bought shares back a little bit. I mean, what can I say? When you're starting to look at a company, before you even get to the DCF model, I know I preach on this channel, DCF model. Oh my God, we gotta, do the fundamental analysis. We'll project the free cash flows out and discount them back and get the value for the company. That's the most important freaking thing. But when you're looking at a company, you may be able to essentially look at just some basic financials. Like, look at these basic financials. Looking at their 10K is obviously a good thing too, a deeper dive, but you may be able to see some basic numbers here and already know I'm not going to waste my time looking at this company because, something may not look right to you, like maybe them being wildly unprofitable and diluting shareholders. So a quick look at this tells us that, PayPal's looking pretty healthy with their growth and just looking like a stable company. So now we can go ahead and jump into our discount cash flow model. Now, before we jump into that, we do have to figure out two things. One, a revenue growth rate, and two, a free cash flow margin that we want to apply on the model. And if we're looking at revenue growth rate, over the next 2 years, the average analyst has PayPal growing by 11.7%, and then the following year, 16.5%. Again, the 11.7% is sort of overall representing the year 2022, so I don't know why there's such a big jump on the average analyst expectations for 2023, except maybe they think that that deal with Amazon will be kicking in full steam. I'm not quite sure why that's the expectation, but it is. Overall, we've known, PayPal has said in the past, we're comfortably going to be growing at maybe 13, 14%. I think maybe even anywhere from 11 to 14% was thrown out there before. I don't want to go as low as 10 just because of how stable they are. And I do think they'll continue to grow. I like 11%. It's definitely under what the average analyst expect. I don't think it's too low, but I still think we're going low enough where we're at least being a bit conservative. Okay, so 11% growth rate. Now we need to figure out a free cash flow margin. That's super easy, especially when you have a stable company like this with a little more consistency. I looked at the last 5 years of their free cash flow versus their revenue. Because remember, to get a free cash flow margin, you just do free cash flow divided by revenue. And the free cash flow margins read as the following: 14.2%, 30.1%, 18.9%, 23.2%, and 21.4%. Now that's kind of, in a way, a little all over the place. The last 3 years, thankfully, have been the ones that were most consistent. The last 3 years was the 18.9, 23.2, and 21.4. 4 years ago, for whatever was like 30%, and then the year before that was 14.2%. That's obviously way too low. Look, there was probably, I didn't look, but there was probably some higher capital expenditure that happened that year, and that's why the free cash flow was lower, therefore the free cash flow margin looked lower. But as we know, capital expenditures can be really a one-off thing, so I'm definitely not going to go like, oh, that was the lowest one there, so we're using 14%. That really doesn't make sense. And if we look at an average of the last 5 years for free cash flow margin, it's like close to, 22%. Again, the two numbers really skewing it is that 30 and that 14, so you can almost throw those out. So I'm more so looking at the last 3 years, which was, again, and I've got it on my paper here, 18.9%, 23.2%, and 21.4%. I think a good free cash flow margin to use in this scenario is 20. Let's just go a flat 20. Okay, so we've got all of our numbers for our model. Okay, we've got all our numbers for the model now, so let's go ahead and run this bad boy. But before we get to that, if you're not subbed to the channel already, make sure that you subscribe to the channel. It'll help you keep up to date on all of my content, all of these deep dives that I do on stocks. I've been doing some other kind of videos where essentially I pick a topic that I talk about when I'm like driving in my car, just making an attempt to make more content. If y'all don't like those videos, let me know down below. I'm of course always going to be doing these higher quality deep dive videos and DCF models in my office here. But, I feel like sometimes I only get to upload like once or twice a week at best. So I've really been trying this thing where I record in my car and, it's not as refined because I can't edit the videos, or that's not the style I'm going for. I just kind of want to talk about financial topics with you guys. So if that's something you guys like, let me know down below. If you don't like it, let me know down below. I am totally open to, criticism, hopefully constructive criticism, and just let me know your thoughts. And do not forget to smash the like button, okay? I hear there's this thing called the YouTube algorithm. I'm just trying to get my content out to as many people as I can, because hopefully I can help people out who get to see these models and just my perspective and my opinion on stock picks. Okay, but without any more delay, let's get into this model. So I've got it up on the screen here. As we said, we're going to grow PayPal out by 11% out to the year 2026, which is about $42.7 billion in revenue. We apply our free cash flow margin to all the projected revenues. We need to get our terminal value. You apply a weighted average cost of capital, or WACC. I get mine from finbox.com, and for the mid, they had 8.5%. We also apply our perpetual growth rate. Now, once you have that terminal value as well as your projected free cash flows into the future, we need to discount those back. I like to discount it at a rate of return of 12%, so a discount rate of 12%. Then you'll add all those values up, divide by shares outstanding, and we get an intrinsic value of 92.91. Or, we'll just round it up because it's so close. We'll round it up to about $93 a share. All right, sweet. So based upon the model, the share price came out to 93 a share. Currently, they're around 80. According to the model, it's a buy. PayPal is currently undervalued. I'm really not too shocked by this. I mean, here's the thing. PayPal ran up in a way that made 0 sense, but so did a lot of financial stocks, and it was way overvalued. Now it's come way, way down, and it's been so overly done and aggressive that I think it's a buy now. And according to the model, it is a buy. I haven't bought any PayPal stock yet, but after running this model, I'm certainly going to look at putting a little money into it, because just the business is growing, it's stable, and I think it's just been beaten down too much. Now, could it get beaten down more? Absolutely. We don't know where this market is going. As I've said in other videos, if we get hit by a recession, all stocks are going to be affected by default. But, after running the numbers according to this model, PayPal is currently a little undervalued. Well, okay, guys, that's it for this video. Let me know your thoughts down below. Are you buying PayPal, or do you currently own PayPal shares? Or do you think it's not a buy? I mean, I definitely didn't think it was a buy before. I thought it was way overvalued. And even when I saw it dropping way down and it had hit like 121.30, in fact, I think I did a video on PayPal before on my channel. And I said, hey, it looks a little overvalued still. And that's when it was like around 120 or 130 or something. And people were buying it just because it looked like such a deal because it had been beaten down so far. But that's why you've got to do, stock analysis on a company and run a DCF model and get an idea of what the true intrinsic value of the company is. Just because a stock was way overinflated and gets beaten down doesn't mean it's suddenly a deal. It can still be a bad deal you basically need to run a model, and if you know how to do the financials on the company, run your model and figure out for yourself if it is undervalued. Now, again, according to this model, PayPal is a little undervalued right now. Okay, everyone, that's going to wrap this video up. Thank you for watching, and I will catch you in the next one.